right, folks, on the market, I think holding up pretty nicely, considering everything. It's been making a stand all session long. And just here over the last hour or so, actually trying to rally on news that Germany now will, in fact, be coming back online beginning April 20th. But even before this morning's spate of earnings misses and terrible economic data, the market was indicating that it would be a tough session. All night long, the market was down. Now, you could argue that the session was to the downside, really that this is overdue. I mean, consider that the S&P 500 has rallied 30% from March 23rd, that intraday low of 2191, to yesterday's intraday high of 2851. The question now, of course, is how much risk is there to the downside? As Wall Street has largely changed its tune on the need for these major indices to retest the lows. I want to bring in my panel of market pros to talk about the potential reopening of the economy and how all of this data informs their decisions. Let's begin first and foremost with my friend Gary Kaltbaum of Kaltbaum Capital Management. We're also going to have Rebecca Walser in as well. She is from Walser Wealth Management. Gary, first up, so we've got the Bank of America. They've come out with this survey of these global money managers, and these folks, they handle a lot of money. Now, we've seen a surge of cash, but here's what we're not seeing is, and the question, of course, is what kind of recovery do we get? Some think there will be a V type, a U type. There's the W type. There's the L type. The V, of course, is short term. U type would be a gradual return of the economic growth. The W, a double dip recession. And the worst would be an L shape. That would be a severe long-term recession. I want your opinion on what you anticipate, and more importantly, how someone should potentially set up their portfolio.
Yeah, a lot of letters being thrown around, Charles. Look, I believe that we're going to have a real nice pop off the get-go. That's just normal. But I think after that human nature by consumers in business, there's going to be a heck of a lot of reassessment based on demand, which will basically lead into how much capacity. If you think about airlines, they're not coming back at full capacity. They're going to come back at a certain level and see what kind of demand is there. I'm also thinking about the health part of it. You know, we got Disney World here in Orlando. We have these parades at night where hundreds, if not thousands of people are standing shoulder to shoulder with kids sneezing and coughing next to you. I wonder how much Disney's going to do of that. So I just think there's a lot of ifs going forward. So I think we get a real good pop, and then we get reassessment after reassessment. Longer term, I'm not worried. I think we'll get back to the norms. I just don't know how long term it is. And I think the people calling for a real sharp V shape, just straight back up, I think they're going to have a couple things handed to them first before we get there.
Now, Rebecca, to be clear, according to the survey, 52%, the majority, see a U-shaped recovery. So a gradual recovery where we make something of a bottom, to Gary's point, and we slowly work our way back up. I'm not sure what you see, but tell us what you think may happen, and more importantly, how your portfolio is positioned for it.
Yeah, that's a great question, Charles. So I know you want me to put a V or a U on it, but I want to say it's a hybrid, right? We haven't seen this before. So I do see that. I don't know that we're actually at the bottom yet. I do see, and I won't call it a double dip. I don't think that's what it is. But technically, if you want to be honest, by the time the financials and earnings season hits, kicks in, and we really see the depth of the impact, like we saw starting with the financials this week, I think we are going to see potentially some more downward pressure. So I'm not necessarily saying that we've seen the worst of this yet. And I think you have to see the worst of it in order to get a V recovery, right? So that's where I don't see us there yet. But if we do see some more downward pressure, I do see some more downward pressure, Charles. When the financials hit in, when earnings season hits in.
So then how would you position your portfolio for this, Rebecca?
Say that again, Charles. Sorry, never talked to you.
How are you positioning your portfolio for this?
I mean, unfortunately, right now, we're definitely more in a cash position than we would normally like to be in. We definitely don't see that we're at the full bottom yet.
Okay.
This is great information on Germany. We need a world leader to step up and say, let's get back to normal. So that's awesome news, very encouraging. But the United States needs to do it. The United States needs to let the economy start to lead and not all of this medical science that has been completely wrong and totally overblown, and we've basically committed economic suicide, and it's going to take some time to recover. But I do see, once we start to reopen and once people know they can go out and not die, then, some kind of medical protocol like Gary was just talking about, then yes, I do see us actually recovering. And I think it's going to be a fast recovery. I'm not saying we're going to get back to our highs, but that I agree with Gary. We're not going to just pop back up to 29,000
We've got some medical experts coming up later in the show. to talk about that part of coming back. I do want to bring in now, though, Courtney Dominguez, Payne Capital Senior Wealth Advisor. I'm not affiliated with the Payne Group. Courtney, again, you know, I thought it was interesting because you have a variety of ways that this economy could come back. You know, of course, the best will be a V-shaped recovery. Most people are discounting that. Most of these professional money managers are saying a U-shape. In other words, a gradual return. I want to get your idea of how we come back, but more importantly, people are watching this to say, how should their portfolios be positioned? Because I think portfolios are going to look a lot different in the future than they did in January and February.
Very much so. And I think we just really need to look at this and understand that we are getting a lot of bad data coming out. And I know we've kind of alluded to that. There will be some negative news, but we need to separate the fact that there's going to be news showing how the economy is doing and how the stock markets are doing. The stock markets have already discounted most of that information. And so we want to make sure that we're taking advantage of these things because the markets are not going to wait for clarity in the data to happen. They are going to bounce a lot sooner.
Right.
The question is whether that's already happened, but I think there are a lot of optimistic signs. They're not reacting quite as much to every single data point. Actually, I see that as a really positive sign that we're just making sure everyone has the position to just take advantage of these dips as they happen. And you don't want to wait too long for maybe there's another happen. Sorry, go ahead.
And to that point, one of the big economic reports out today was retail sales off 8.7%. Now, that was slightly worse than consensus, although I got to tell you, folks, there were some estimates out there for it to be off as much as 15%. By the way, it wasn't a complete disaster. There were some bright spots: healthcare, building materials, general merchandise. In fact, the so-called control group, which goes into the GDP, was up 1.7%. So I want to, again, talk about maybe investment takeaways. Gary, I'll come back to you. I like the retail sales report. It has informed me on investment decisions in the past, although I thought Home Depot, for instance, would be better on the idea that building materials and garden supplies are up. Some firm knocked it, so it's not doing so well. These kind of notes, this kind of data, how does it work for you?
Well, first off, I thought 8% was a miracle based on, just going out and seeing so many things shut. So I think that's good news. Look, I think when all's said and done, Home Depot and AutoZone, these type of places are going to do well. But I want to tell you, viewers, one thing that is sticking out, and I always talk about the sore thumbs, the small caps, the Russell 2000, has hardly even budged off the lows. So make sure if you're invested, you are in the larger cap liquid areas. And I think that's what the big institutional money's doing. They're realizing, just in case, stay with the big caps, because if you just take a picture of the Russell versus, let's say, the NASDAQ 100, it looks like two different worlds right now. So I'd be very careful that way. I'd stay out of the oils. I'd stay out of, ultimately, I think cruise lines and airlines will be okay, but I still don't see any life in them. And the airlines are down today, even though they got big bucks yesterday. It's going to be very tough, and longer term, I think we'll be okay. And you go with the big growth names, as I always do.
I agree. There's always a tendency, Rebecca, to buy the losers, assuming they're going to become winners. I think Gary's right. The winners to my mind, are revealing themselves to investors bright and clear, like neon lights. We don't have much time left in the segment. So I know you're a little bit more cautious toward the downside here. Is there a group that's standing out to you, though, that might be where you want to be overweighted?
I still think that airlines are a great buy right now. I know that they don't look like it, and that and even cruise lines. I know that sounds crazy, but I promise you, the world will return to some level of normalcy, and the cruise lines are going to adjust. They have beautiful cruises and beautiful ships, and I know people that are on cruises right now. It's actually crazy to think of. So, I think that you can maybe look at that and say it's an industry that will make a lot of profits and will recover.
All right, listen, I love contrarian thinking. And by the way, the Saudi investment fund loaded up on Carnival Cruise Line, so you might be right. So, Courtney, we'll spend more time with you next time. We're out of time right now, folks. But I do want to announce, I'm very thrilled to announce that next Thursday, I'm hosting another virtual town hall, America Works Together, right here, 2 p.m. So if you're